Hello, I'm Aaron Klein, a fellow in economic studies at the Brookings Institution in Washington, D.C. I'm really pleased to join you in this panel of experts for what's going to be a scintillating discussion about defining, explaining, debating central bank digital currencies. Look, we've run out of three-letter acronyms, and we're now up to four, and the hottest new one is CBDC, Central Bank Digital Currency. People throw it around like it's going to transform the universe, or is it just going to be another fad? We're here to dive deep into this, and I'm thrilled to be joined by four of the smartest, most interesting people in the world on this subject matter. Let me start by introducing our panelists for this conversation. Alistair Milne is a professor of financial economics and co-directs the Center for Post-Crisis Finance at the School of Business and Economics in Loughborough University. Harish Natarajan is the lead payments and market infrastructure and finance competitiveness and innovation at the World Bank. Arwen Smit is an author and a senior advisor. Her book she specializes in technological ethics, its intended and unintended consequences on society, and her book, Identity Reboot, Reimagining Data Privacy for the 21st Century, is a must-read for people trying to understand how we're going to identify ourselves when we want to and when we don't in the future. Finally, Marcos Zacharidis is a professor in financial technology and information systems at the University of Manchester at the Allianz Manchester Business School. Welcome, everybody. So, we're here. We're debating the central bank digital currency. And as I said, you can't kind of go anywhere in this without people throwing it around. But far too often, people jump into this conversation without defining it. And when you don't define a term that is some futuristic advance, it becomes very easy for that to become the solution to everything. And yet you walk away not understanding what it is. So before we get into this, I want to ask each of you to define what a central bank digital currency is, and note whether it's something new or how it's different from something that previously exists. Because I often struggle with a lot of these definitions, and I'm going to hold your feet to the fire on this, in which is this something actually new, or is it simply a new term for something that we've been using for quite a while? So who wants to jump in here and actually define the term, and let's hash it out so all of us agree what that definition is before we go forward.
So, Aaron, it's Alistair here. I'm happy to offer my view on this. And personally, I prefer a very broad definition. So I prefer to think of central bank digital currency as potentially being any form of central bank account which is held by non-banks. So it could be ordinary private citizens, it could be non-bank financial institutions, it could be others. Now, to that extent, it's not actually quite so new because it's already common for governments, for example, and financial infrastructures to hold central bank accounts. But the issues are about should we widen the range of potential account holders and exactly how should those services be delivered. That's a very broad definition. Not everyone's going to want to look at things that way, but I think it's helpful because it means we get the biggest and therefore the best picture.
Great.
Right. Let me perhaps add on to that. Well, what Alistair is saying is perhaps broad, but actually it narrows it a little bit by saying an account. I would perhaps broaden it by saying it is a liability of the central bank. It might be in the form of an account kept with the central bank, or it might be an account kept with some other intermediary. But I think the key operative part is that it's a liability of the central bank. Versus the current ways in which we transact and hold money, it is typically a liability of the institution which you're holding and which is not the central bank, often for individuals and non-bank entities.
So the way I think about central bank digital currencies, I more see it as there's a bucket of characteristics. So central bank digital currencies are always digital assets. These digital assets are then accounted for on the digital ledger. And I'm sure we'll get to this because ledger could be distributed or based on another form of technology. But the point of that ledger is to act as a single source of truth. then, as my fellow panelists already mentioned, they're always central bank backed, but they're also central bank controlled, meaning a central bank controls the supply of central bank digital currencies. And maybe another view of how it's different is exploring the reasons why it is used. So one of the most often cited ones is there is a decline in the usage of cash, but where it might differ from existing alternatives is that it is attractive to manage the risks of private money creation. This is, for example, the reason why the US Federal Reserve is researching central bank digital currencies to counter private currencies such as Libra. But there could also be public policy objectives that are being explored. And where central bank digital currencies are interesting there is that they're not only digital, but they also have the characteristics of being programmable, which is why, for example, it could apply to a country like Sweden. And then lastly, there's also a geopolitical angle. So if you look at why it would appeal to a country like China, is that their explicit goal for their central bank digital currency project is to protect monetary sovereignty, which has an implicit link to ultimately compete with dollarization of the global market.
Well, my perspective, I mean, it's always difficult to define things generally. I think I like the latest approach in talking more about the characteristics rather than a very hard kind of concrete definition of what central bank digital currencies are. I think a key characteristic, I think I have to agree with Alistair on that, is that indeed is kind of like a system to me that will provide greater access, and by greater perhaps we can talk about wider access or faster access to central bank money or central bank accounts held within the central bank. Almost like perhaps a new rail or a payment scheme for those who are familiar with payment schemes, depending on the different economies, of course. And you know, that would help more in the direct settlement side of value transfers across a financial system. I wouldn't characterize CBDC as a currency because I think, and again, you know, in terms of how do you see it, it's not a new currency per se. But I think I very much like the digital characterization or element in these title, because I think that implies, first of all, as mentioned before, part of it is that, you know, it can be a more programmable system, so that kind of opens up new directions of doing new things with this technology or the system in terms of its smartness, let's say, but also the fact that it can provide access to data, and I think these would open new possibilities for both consumers in terms of benefits and different access to services that they can consume, but also intermediaries in terms of business models and monetizations of this data.
So let me go back on each of you on these definitions, because I'm still not clear, and I think some of your definitions contradict with each other. So I'm gonna play a little speed round, and then what I'd like is each of you to say, you know, pile on, if you will, or jump in here, or defend your choice. Alistair, you say it has to be held by a non-bank. So when I take and digitally on my phone transfer my asset, my electronic asset from my bank to PayPal, it suddenly is not digital currency in my bank, but is in PayPal, unless PayPal becomes a bank, in which case the same asset ceases to have this property. Harish, you talk about the liability of the central bank versus the institution, which is great in the sense that, you know, when I use my debit card, I'm not using a liability of the central bank, right? Cash is a liability of the central bank. The debit card is a liability of the bank. When I make a mortgage, right, that is money created on a fractional reserve banking by my private bank, which then contradicts a little bit with Arwen's point that it has to be created and an asset of the central bank. So in that case, I kind of ask the question, how can you create any central bank digital currency that's both a liability of the central bank and not the private institution, but compatible with any type of fractional reserve banking system? And Marcos, you talk about kind of greater access. I mean, what's greater access than physical papered cash? I mean, by definition, anything that involves a digital nature is a restricted portal to a smaller subset of people that can hold something physical, not just having the means to have one of these things, but the data plan and all the rest. So if what makes something a CBDC is kind of that it can be more accessible than cash, is that really actually a null set? So everybody's definitions kind of contradict with each other. How would you sort it through? Who's right? Who's wrong? Why is it $0?
Let me have a crack at this.
Yeah.
Okay. So I will be as specific as I can possibly be, which makes it very easy to attack it. So I think that there are currently three main forms that people use when they think of constructing central bank digital currencies. The first one, and this is already where it gets a little bit tricky because everyone uses different terminology, is direct issuance. So this is a direct claim on the central bank, and the central bank would handle retail payments. They would handle the KYC, the AML. So obviously this comes naturally with a high operational cost. Then the second form, which is sometimes called hybrid CBDC or token-based CBDC, is where CBDC is a claim on the central bank. The central bank would record retail balances, and intermediaries handle the retail payments. So these are two steps. And in that last case, that could be, for example, another form of money like cryptocurrency. And then I think there is a third version of this where people are calling it two-tiered issuance CBDC. And their CBDC is a claim on an intermediary, and the intermediaries handle the retail payments, whereas the central bank handles the wholesale payments. And I think that's closest to our current model.
I want to totally agree with Arwen. I think there's, even if you read stuff that's written by, for example, the Bank for International Settlements, they argue there are two forms, direct and indirect, and that's kind of circulating a lot. But I think that's missing the key point that Arwen has just enunciated, which is actually there are three possibilities. And for me, the most attractive one, I'm not sure about the word token-based, but it's the idea that the value is held at the central bank, and it remains, as Harish says, a liability of the central bank. But our new monetary technologies allow us to give third parties what I would call delegated control. So I can pass over to a third party who will provide all the retail add-ons and other possibilities of programming of that money.
I think, Aaron, here we are actually kind of looking at different aspects of the CBDC, right? So kind of from a definitional perspective, I think it might be useful also to look at the different characteristics which typically people talk about whenever they talk about a payment mechanism or a currency in general. It is about who's the issuer, then what form it takes, whether it's physical or electronic or digital. Who can access it? Is it individuals or only financial institutions? And then what's the transfer mechanism, right? How do you transfer from one individual to the other, and how do you use it as a payment mechanism? So I think the different variations which people are talking about is when you start looking at for each one of this, you try to put each of these characteristics together, and you can have different names for the CBDC, right? But I think the key operational part really is about that it is digital access to central bank liability. That access doesn't have to be through an account maintained at the central bank, but it could be accessed through other intermediaries. But the legal form and everything is such that it is remains a liability of the central bank. And Aaron, you were questioning earlier that if it is a liability of the central bank, then what happens to fractional banking? That's a good point, and that's where a lot of the implications of CBDC on the banking sector and the real sector comes in because of that, right? Because when the moment you have a central bank liability being used for payment mechanism, you can't do fractional, you can't do money multipliers based on that. No? So you have $100 of CBDC, then that's what is there. You can't have a bank then multiply that twice or thrice by giving out loans. That cannot happen. No? So I think in that sense, this means no fractional reserves.
Harish, this is a little bit of a detail, but I'd give a caveat in that last statement. It is possible if you have a central bank, a ledger on which you're issuing central bank digital currency, it's perfectly conceivable that banks could put high quality loans against that ledger as collateral in a fairly automatic way, and then that would in turn create money. So you can actually go quite a long way towards the existing arrangements where banks create money through lending. But there has to be quite careful kind of consideration about exactly how it happens. So that suggestion that CBDC, if it's widely adopted, rules out fractionally reserve banking, I think is often a little overstated.
But let's dig in on that little tangent for a second, because what if a bank puts a loan in there, what's to stop a non-bank from putting a liability up against that? I mean, one of the problems in some of the cryptocurrencies that you've come out, there's a good paper on this by former CFTC chairman Tim Massad, that, a lot of the custodials that are holding these digital assets, it's not clear if it's your asset or you have a claim on their general liability ledger, and that they're engaged in fractional reserve control of these assets and speculating on price changes. Because let's acknowledge, whatever the central bank digital currency asset is, it's going to float at some level relative to other prices. And you could if a CBDC, Alistair, is in your world in a non-bank entity, who's regulating that claim on that ledger if they're starting to if they're starting to go against it?
Yeah. I don't think it's such a problem. The point I'm making is that you can reconstruct the ability to create money through fractional reserving, but obviously it has to be tightly regulated. So you're going, as it is today, so you're going to have quite strict limits on which institutions can do that, and the quality and exactly which loans are eligible for that type of treatment. So the paper I wrote on this a few years ago, 3 years ago, was suggesting that it should be only short-term lending, so anything up to 12-month maturity was one of the suggestions I had, and with some sort of percentage reserve requirement. So a loan worth $100 to a good quality counterparty, you could create $80, for example, of money against that. But my main point is that it's such a rich world once you move on to programmable digital money, that there are actually a huge number of opportunities. People raise lots of problems, but actually if you think it through, there are potentially solutions to most of those problems, but it requires a re-architecture.
Right, no, but I think the point, Alistair, you're making, I think, is valid, that it's not that the banks will lose their ability to kind of find a source of funds for making loans, right? So I think that's not the point I was making. All I was saying is that if you have kind of, say, a particular amount of currency as central bank digital currency, even if you hold an intermediary, that is different from a bank deposit in the sense that that money has to be fully backed up in the central bank, right? So that's the point I was making. So I'm not saying that introduction of CBDC means the banks cannot have other sources of funding for making loans.
So let's pick up on that thread, Alistair, about some of the excitements on the new technology and payments and the new ways that you can do this. One of the things, and Arwen mentioned it, that about accounting. And it feels to me that you can't have a new conversation about a new idea that's digital without it becoming intermingled with blockchain, right? Whether or not blockchain is the right answer, could you ever envision a new Silicon Valley technology being rolled out like Libra that says, oh yeah, and we're going to settle on a traditional Oracle database like everybody's been doing for many years, right? Is blockchain really necessary to be part of central bank digital currency? Arwen, you kind of hinted that you thought it was one of the key elements. Marcos, you kind of said it has to do more with what the outcome is, whether that makes it easier or more accessible. What do you think?
I actually don't think it necessarily needs to be one of the key elements, but it could be. So if you look concretely at what the Bank of England recently put out, is that they provided a pretty detailed example of how they view two-tier issuance. So on one layer, you would have indeed the central bank core ledger, which could be blockchain, but not necessarily. So that's the layer where blockchain would likely come in if it is used. Then they have a second layer on top of that where they would have API access from approved accounts. Then the third layer would be the payment interface providers or intermediaries that also provide different services. And then on the fourth layer, you have the users. So that's one version where blockchain can come in. A completely other version where blockchain-related technologies might come in is cryptocurrencies, and then specifically stable coins. But that would take the conversation in a slightly different direction.
Yeah, I think I would agree. It's not necessary to have blockchain-related technologies. But again, depending on people's definition of blockchain, even if we use terms like distributed ledger technologies, I think one could think of some very important characteristics these sets of technologies or foundational technologies have, like, for example, the cryptographic elements that they incorporate so that they can secure data, or that they can make the identity and access verification kind of better. And so, again, I would agree. I think it's not really necessary, but certainly can use a lot of these elements to, in the context of CBDCs, various kind of manifestations that they can exist depending on the architecture. And of course, there is, because of these, there are certain, premises like transparency, for example, which you cannot. And when we talk about data being held in a database, I think that would help better with the access and also, in terms of looking at the data. So I think that's another aspect of it.
Aaron, when I was earlier describing, I mentioned about the transfer mechanism as one of the aspects to kind of clearly identify what type of CBDC we are talking about. And the transfer mechanism could be the traditional technologies, including existing payment systems, or it could be blockchain-based, right? And I think the key distinction really is about whether you want the ability to transact between individuals, between businesses, on a pure peer-to-peer basis, equivalent to the way you deal with cash today, that you are able to hand over a currency note or a coin, and nobody else is involved. It's just the two counterparties. And if you want to look at it in the digital version of that, if you want to do that, then you perhaps at this point need something like a blockchain. Even if you are doing it digitally, but say directly through APIs with the central bank, you still have the central bank as an entity coming in between. Or if you look at the other indirect models, you have other intermediaries like banks and non-bank entities who are offering you the service come in between, right? So it is not a pure peer-to-peer like the way it is with cash, right? So if you want a pure peer-to-peer, then you might need to go in the direction of a blockchain, at least based on the current technology. You can always imagine that traditional database technologies might evolve to allow you a peer-to-peer, but in today's technology, the way it is, looks like blockchain is necessary if you want to do pure peer-to-peer.
So let's both touch on that and move on, because PayPal seems to work peer-to-peer without.
Yeah, Aaron, I think I have a point I want to interject here. So I agree with what Harish is saying, but I think I can elaborate a little bit further. To me, the key issue is not blockchain or some alternative database technology, but rather, are we talking about transfers on a single ledger, or are we talking about multiple ledgers? So commercial bank money is multiple ledgers. Every commercial bank has its own ledger of accounts held, and that implies that you require settlement, which is necessarily institutional involvement. The commercial bank may hit a liquidity crisis. There may be a run. It may not be able to settle its obligations when due. As soon as you move on to a single ledger, and PayPal is a great example of that, then you can have almost instantaneous. Whether we call that peer-to-peer or not, I think is more of a question of terminology. But it's the shift from multiple ledger to single ledger, which I think is critical. And one further point, I think it's a key issue in the development of CBDC is going to be integration with existing payment systems. I may be able to get CBDC on my phone, but if all I can do with it is hold it on the phone and maybe I can move it to other phones, I'm not sure that's so interesting. But if I can take it to the supermarket and make payments, if I can pay my gas bill and my utility bills, in other words, if there's integration into existing payment schemes, then it becomes more attractive. And for that to happen, it's a one-way street. It should be fairly easy because it's a single ledger in the settlement asset. There's no great technical or economic barrier to making payments from a CBDC account into, if we call it an account, into commercial bank money. There will be potentially limitations going in the other direction.
So let's just build on that.
Just one point, Aaron. I think it's important to highlight that. So when you talk about PayPal also giving you a peer-to-peer experience, I think that is, yes, you get a peer-to-peer experience, but the fact is that PayPal is an intermediary in between. And if that system goes down or if something happens with that entity, then basically you cannot complete the transaction. And in a peer-to-peer, what you really mean is that you're not dependent on any other intermediary. Like in a cash transaction, you're not dependent on any other intermediary. So I think that distinction is important to keep in mind.
So it's true, although in a digital environment, there has to be some technological intermediary almost by necessity, right? If the computer goes down, if the phone goes down. But let me ask you guys, wholesale, retail, both or neither? Because a lot of this conversation is devolving into the settlement, the way that Alistair framed it, that this could work for wholesale, it could work for retail, it could work for both or neither. Let me ask you, where is this going to happen, if at all, first and second? So if you say both, you got to say which one's more likely to happen first, or you can lean in either way and say seems to me CBDC is a lot more exciting for wholesale or a lot more exciting for retail. Alistair, let's start with you and work back around.
Well, I think it's going to vary jurisdiction by jurisdiction, but I think in advanced countries, I'd expect to see wholesale CBDC being the earlier development, and I think the demand for that is about competition in the payment space. So an argument of an alternative money provider like, say, TransferWise or others, they have to deal sometimes with quite substantial net imbalances in different currencies. If they have direct access to the central bank through a wholesale CBDC, that can take a lot of the cost out of their business model. And that would be one example. But actually, that could be replicated if you're looking at, for example, securities settlement or foreign exchange. Wholesale CBDC could make a substantial difference. Retail is a further and actually more difficult story because there's extending it to individuals and managing identity and a whole range of further challenges.
I think I would agree. Just to jump in, since I think I have a similar view, I think wholesale, for all the reasons that Alistair mentioned, but also, and of course that would vary between jurisdictions and economies at the level of maturity they are in terms of the financial infrastructure, and so on and so forth. The perceived demand will be the judge here and what is to go first. But I think wholesale, definitely in developing countries. And also the extra reason is because of the difficulty of implementation. I think it's a lot easier for a central bank to test this with a smaller number of institutions that were more mature and have the resources to respond to these tasks rather than kind of like a large scale big bang execution across the entire society. And then potentially we may see kind of retail following up. But that also really depends on the demand and maturity of the rest of financial services.
But China could be very different because it so often is.
Yes. True.
Yeah, kind of from my perspective, I think one can argue that on the wholesale side, it is already digital in a sense that all the commercial banks and everybody has reserve accounts with the central banks. So in that sense, for them, they're already able to do digital. They already have a direct access to central bank liability. So for it to be the central bank digital currency to be introduced in the wholesale market, it has to then bring in additional characteristics, right? So additional characteristics of it being available 24/7, you being able to transact on it without necessarily direct involvement of the central bank. So I think one has to look at a different range of characteristics which will have to be introduced for the wholesale side. Of course, there could be also more institutions who can be allowed to get direct access to central bank accounts, like non-bank entities and so on. On the retail side, there are various kind of variants which have been talked about. So if you look at even in the indirect model of the individuals and businesses not having a direct account with the central bank, it's a different experience for them. It can have certain kind of positive and negative impacts. So you might be able to introduce that without necessarily introducing many features, right? So I think it really depends on the market context and what really is important in a particular given context.
I actually agree from the moment that Alistair started speaking, basically with everything that followed from all three panelists. So I do think that in more established economies that also will get a priority, and I do believe that in emerging markets, the focus will be more on retail, and that's just because of the needs that are present in those respective markets. So in emerging economies, there might be a bigger focus on the potential, not proven, but potential for financial inclusion. And I think, as Alistair rightly mentioned in his point, that you do need a pretty robust identity infrastructure there. So you might speculate that in emerging economies, if CBDC retail does happen, wholesale will follow quite quickly, whereas in more mature economies, wholesale might happen, then nothing for a while, and then you might have retail. And just one caveat that we cannot fully predict, I do think that it matters a lot what kind of private money initiatives are being set up. For example, the project of Libra completely accelerated this entire discussion, bringing it to the forefront. So if something like that happens, it definitely would change the roadmap that we're looking at, both out of necessity, but also because people are themselves becoming more interested and educated in actually using it.
So Aaron, you may be worried we're agreeing too much, but perhaps I can briefly argue against myself, if that's not too complicated.
Either way, you'll be right and wrong.
Yeah. So while I would agree that generally it's wholesale in the advanced markets, there may be particular reasons why retail will still be taken seriously. And of course, the Swedish e-krona is a specific example of that. So that's the country that's had the most dramatic decline in cash usage, and there are key questions about how do they maintain the equivalent of a cash infrastructure, and can they design something of a digital format that will be much cheaper and more efficient. But I would envisage that being almost a special case. It might be based on something like smart cards. There would be limits on the amounts that could be held, and that would still be CBDC, but it would be CBDC in a much narrower functionality than what we've been talking about so far.
So it's interesting that you say that, Arwen, because one, there's a myth that cash is shrinking in the U.S. There are more $1, $5, $10 notes in circulation every year. It just ticks up. Number two, 1 out of every 10 swipes at a U.S. cash register is on a prepaid card. There's a whole way that the folks without fancy Amexes bank and live. And, as the central bank and the elite become more and more detached from the experience of the common person in how they transact, we begin to miss the reality which is no longer shared. Let me disagree with all of you in this sense and ask you to explain this, right? China had two non-banks, Alipay and WeChat Pay, come in and swoop the entire retail payment system while the banks sat around with Union Pay thinking that they'd get everybody to adopt the same inefficient magnetic stripe card system that the US started and transmitted to Europe to dominate the world. Eventually, the central bank reacted. They started to reduce the amount of money creation. This was to an earlier point by putting in new reserve requirements. But the reality is, walk around China and what's more helpful? A plastic card, a piece of Chinese currency, or a QR code? I think we all know the answer. Kenya is another example of a much smaller economy, which somehow it seems to have much more scholarship written on the M-Pesa experience. But again, you have non-banks introducing digital ways to transact and record asset ledgers and transactions, swiping very quickly, if you'll pardon the pun, the entire market share in a retail space much faster than the wholesale market. Meanwhile, you have central banks promising more research, and I agree with you, Arwen, certainly accelerated by tech companies like Facebook talking about their own asset. Although one has to wonder, when you see Apple's largest expense on the iTunes store is swipe fee, and Starbucks having $1 billion of outstanding gift cards, trying to drive yet again transactions off of this expensive infrastructure. So let me push back on this, right? I mean, these are pretty developed countries, the US, Sweden, China. Is there the possibility of a non-centrally banked digital currency or digital transaction mechanism moving so fast that it drives central banks, who are the laggards, not the leaders here?
Let me push back on your pushback. So I think that in China, the things that you just described, arguably, if that could be a bit controversial, are mostly UI innovations. If you can pay with your smartwatch, if you can pay with your phone, you don't change the architecture that sits behind it. You change the interface with which you are paying. And what I think is terribly exciting about central bank digital currencies, and I think Alistair already mentioned it at the very beginning of our discussion, is that you actually create innovations in the architecture that sits behind it, and therefore letting you do and build completely different things.
I guess my economist response to this is to go back to the notion of platform externalities, that when things are established and there's users on both sides, I think it'll be quite hard to wean card users, accepting your point that the experiences of the elite, as you put it, can be rather different from the ordinary person on Main Street. But I think it'll be difficult to wean us off card-based systems of Visa and MasterCard in the development, because so many are already using them. It's a very well-established platform. But where you have a vacuum, then there's the opportunity for some very rapid takeoff.
I think you mentioned M-Pesa, Aaron. I think the story in M-Pesa obviously was that there's it started from a country, Kenya, with a very large financial exclusion. So people saw it as an opportunity, basically, to use a new system to exchange value, and that's why it kind of picked up really quickly and became a success story. And there's also lots of academics writing papers on it. But it's not going to work everywhere, and it's not going to work in the different contexts, because, we did mention before that there is quite a bit of variation, both cultural, economic, and financial. For example, a good case study I've been reading recently was that M-Pesa, even though kind of it worked amazingly in Kenya, it failed dramatically in neighboring countries where you would actually expect, they would probably have similar issues. So there is, I think the context really plays a big role in that. And I guess my second comment, because you also mentioned Alipay and WeChat, I think I would agree that you'd have to look at the architecture when the innovation comes on, if it's at the top layer of the interaction, the user experience. But I think in these two examples in China also was the entire business model of these organizations, that they provided a super platform that because there was a lot more value proposition as part of this suite, people were seeing a lot of value starting using these payment systems because they could integrate directly into services. And I think Libra, in a sense, is trying to replicate that, albeit a bit later, a few years down the line. But I think they're kind of envious of what Alipay and WeChat have done, because they provide a super platform with all the services. And as Alison mentioned before, there's network externalities there in play, because the more value you can incorporate into a platform, the more the efficiencies and the value your consumers kind of can experience, and they will cluster a lot more on your platform. So there's a lot of dynamics playing here, both economic, operational, and I think financial. So it's, but it's an interesting question, I think. So
yeah, it's also interesting that you compare the example of cards and mobile money, and then kind of mobile money in general has been successful in a number of countries. Alongside a lot of other initiatives which have advanced financial inclusion. The question also to ask is, from a user experience perspective, what is it that will be different with the CBDC versus some of these mechanisms, right? And one could argue that perhaps there's no difference, what perhaps CBDC enables is something which we are perhaps not really imagining now, right? So it's more about, it creates the possibilities of doing something which we cannot do today, and we are being limited by our imagination here, right? So to try to, but if you compare it with what is their mobile money user experience today, I would argue that there's no difference really. It will be the same, and also in countries which have introduced fast payment systems, it will be fast, right? Fast payment systems in the UK, a number of other countries in India and so on are quite far. And in seconds you can move money from one institution to the other institution, 24/7, right? And in that sense, there will be no change. But it's all about what it might enable, which we are not able to imagine now.
Well, I'll agree and disagree in the sense that you're right that it's all about the platform. Apple Pay is no innovation whatsoever, but you can exist in life in an Alipay, WeChat Pay world with no bank account, with no money ever touching the bank, as witnessed by the homeless folks who sit there with the QR codes out there. Look, we only have a couple minutes left. I encourage the audience to start thinking up some questions, but the conversation would be incomplete if we don't talk a little bit about privacy, right? Cash has a different level of privacy. Even when you make your cash electronic through gift or prepaid cards, there are ways to be anonymous. Depending on how you describe the central bank digital currency world, anonymity may or may not even be plausible if it's linked to an account or not. What are the major privacy implications here of this? What's going to be the one that drives it, and what's going to be the one that retards implementation?
Gosh, Aaron, we could have a full 45 minutes again just on this issue. There's so much involved in privacy and identity in the world of banking and money and payments. I'll just quickly say I think this is a big challenge for central banks, because it really goes a bit beyond their natural remit. So to have a consistent, effective system of citizen identity, which can be the foundation for CBDC, I think it would be a real goal. But I don't think central banks can do that on their own. They've got to work with government to achieve that.
This is typically one of those situations where you really wish and would urge people to think before they start doing something, because the innovation we are discussing is that if successful, money will carry a data footprint, meaning that there are implications for both government surveillance as well as commercial use of data. And you will see different countries push different value systems through their digital and programmable forms of money. And of course, money is and has always been a political tool. So as soon as countries start encouraging their partners or other entities to hold their objects and basically integrate the behavior of their citizens then with those value systems, you are coming in a situation where money exports value systems.
Yeah,
right.
no, I think that's right. Just to say quickly, I think there needs to be a distinction between privacy and anonymity. I think these are two different things. But obviously, being used to cash and transacting with cash in the economy, you have the choice of both. You can be private and anonymous. I think in a more and more digitized world, it will be hard. Of course, we have privacy in at the current moment, you of course trust your bank that your identity will not be revealed to situations where you don't want to be revealed. But as it was mentioned just now, it's in a digital economy with all these new technologies, you cannot avoid not leaving a digital footprint behind. And I think the anonymity part is going to be a bit more tricky to implement, even with CBDCs. And I think that's where the debate is, depending on the values of different countries and societies across the world. So I think these are things that need to be seriously debated and incorporated into the new systems by design.
To just add one perspective to that, so I think if the world moves to digital payments entirely using current technologies, I think the same issue of data privacy and all of that come in, right? The difference, of course, is that we are using intermediaries who are regulated, and there's a particular legal process related if you want to get access to the information. Whereas with the CBDC, it is possible that all of this information gets centralized in one place, and with an institute perhaps seen as an extension of the government, and which basically creates a different set of issues, right? So I think that's the additional dimension which comes in with CBDC, which perhaps didn't exist with digital payments and digital services in general.
This has been a fantastic conversation. Thank you all very much. And now we turn it over to the audience. Lob in some questions and let's continue this conversation, because central bank digital currency is the hot new thing. How much of a reality it will become, who will know? Let's keep the conversation flowing.
Well, that was a fascinating discussion, and I'm thrilled to now be joined by two of the participants so that we can put some of your questions to them. Alistair Milne and Marcus Zachariadis. Gentlemen, welcome to Sibos TV. It's very early days, but I hope you're both enjoying this unconventional Sibos 2020. We've got lots of questions coming in thick and fast. This first to Alistair, but Marcus, please do chime in at any time. The first question is, in the panel discussion we've just seen, there was a mention of new research. Alistair, can you tell us a little bit more about this?
Well, there's a lot of research going on around the world by computer scientists and by economists such as myself and information management specialists such as Marcos. I think the work that I've been most involved in is about defining central bank digital currencies and how they relate to other more established forms of money. And so the thrust of my work, which will inform what we're doing for SWIFT, has been about suggesting that this is in some ways quite similar to existing bank accounting arrangements, but it's accounts held with the central bank. So it all comes down to what do you mean by CBDC, and for me it's an accounting liability of the central bank, and so I have a couple of current research papers which relate to that. Happy to share them with anybody who wants to get in touch with me.
Speaking of CBDCs, they're going to the future and to replace the physical coins and notes. But what could the impact on a country's economy be with this change, do you think?
It's probably also one for me, Mark.
Either way, really, whoever feels.
Yeah, absolutely. Just to complement a little bit Alistair's comments, obviously this research is going to partially address what the economic and technological impact is going to be from any kind of adoption of CBDCs. And as Alistair said, we are going to start
from trying to define what CBDCs are in the broader context, but also perhaps try and create a taxonomy. And why we want to do that is because we think that different kind of approaches to CBDC, but also implementations of CBDC might have different impact on not just obviously the financial sector, but also in terms of the benefits that consumers will get in the end. And for example, one of the things that we are really keen to study through this research in terms of the technological and economic impact is how it will probably integrate with existing kind of arrangements. And we're specifically focusing on international payments in this particular paper, but also generally on the payment systems and payments business. But also, what are the different implementations in terms of the technologies that can be used? And so we really think that, first of all, defining this, providing a taxonomy, and then kind of exploring different possibilities will give us a good and comprehensive roadmap to go forward and understand a bit more the implications. So implications are going to be part of this research as well. And of course, it's not an easy question to respond to at this point. And there's different approaches and hypotheses about this. So we're going to try and construct this a bit more.
Speaking of these implications, if regulated, can CBDC be used to transfer value between governments? And if that's the case, will this pave a way for a single global currency?
I think that's a separate and further development. There's certainly a lot of discussion amongst central bankers that CBDC might encourage what's sometimes referred to as dollarization, or in the euro world, they like to talk about euroization, so that economies which are struggling economically and financially, their citizens don't trust their own currencies, they might start using the CBDCs of other countries instead of their own national currency. But that's obviously will become quite a political issue. So that's one of the concerns in design. Creating a single international currency, well, that's not really under discussion yet, but of course it could be something that builds on CBDCs once established.
Thank you to Sai Laya for that question. We have one here from Michelle Uppelschurten. Should central banks step up to have full oversight and create trust in digital currencies?
Yeah, I think that's a good question, but one needs to be careful in how much central banks are able to do in this context, or should be doing. I think there is, and as we're exploring the different kinds of typologies of CBDCs, but also execution of such payment infrastructures going forward, because we'd like to think CBDCs for the very big part of the execution are basically payment infrastructures and payment systems. We think that a more kind of hybrid or blended approach might be suitable, and of course this is something that's been reflected across many different existing research papers from central banks, but also private companies. So putting all the weight on the central banks, I think that's not going to be something that the central banks first is going to be very keen to do, both in terms of capacity, but also in terms of kind of involving the industry in such debates, and obviously kind of avoiding everything to be part of what government's kind of remit or the central bank's remit. I don't know if Alistair wants to kind of supplement a little bit or share some insights.
Yeah. I would just add one point. I very much agree with what Marcus just said. As we follow current central bank discussions, I think the most popular model for CBDC is sometimes referred to as a tiered model. So the central bank would issue the CBDC, but it will be actually other intermediaries, such as banks or payment providers, that would handle the retail interface. So the question of trust is part of how you manage that retail interface. Is that a central bank responsibility? Well, it'll vary from jurisdiction to jurisdiction. In some countries, the central bank is also the financial regulator. So I think the question of trust in those intermediaries will then still remain with the central bank. In other countries where regulation is separated, financial regulation is separated from the central bank, then it might well be another institution that's responsible for oversight.
Gentlemen, thank you very much for your time today. Sadly, that is all the time we have for. We'd like to fire questions at you all afternoon, but we have some more content coming up. Some fascinating insights there, gents. Thank you very much. Enjoy the continuation of Sibos 2020. Do stay tuned. We've got another episode of Sibos TV coming up very shortly.